Hi everyone, thank you for joining us this afternoon in week 10 of the SOA at Home Festival. I'm Francesca Howell, Development Manager at the SOA, and today's session is on guiding your finances through COVID-19 and beyond, led by HW Fisher. I'll let the team introduce themselves in a second, but just a couple of things to mention. As I'm sure you know by now, all the SOA at Home Festival sessions are free, but if you can afford to donate a few pounds to the Authors Emergency Fund, the link is at the top of the chat on the right-hand side. This session will last for 45 minutes with time for questions at the end, so please do post any questions and comments in the chat throughout the session. If you have any connectivity problems throughout the session, just click the reconnect button at the top of your screen and you should be able to resolve them. I'll hand over to Andrew, Barry and Chris now.
Francesca, thank you very much and welcome everybody. I hope you find today's session enjoyable. We've done a number of these sessions with the Society of Authors, so it's a privilege to do this in a slightly different format, and I hope you all enjoy it. A little bit about HW Fisher to start with. We're a medium-sized firm of chartered accountants. We're based in London. We have a full range of services, including personal and corporate tax, audit, VAT, payroll, bookkeeping, amongst a number of others. We have a number of specialist groups and departments, including media, music and entertainment and property. But this group that we're heading up is specifically for authors and journalists. And we're involved with a number of membership-based organisations such as English Pen, the Romantic Novelists Association, the NUJ, the Writers Guild, the Guild of Health Writers, the Biographers Club, the Crime Writers Association, and of course, Society of Authors. Today's talk will be led by my colleagues Barry Kernan and Chris Pitzilidis, who you will hear from shortly. Barry is the on-treasurer of the Society of Authors, so some of you may have come across him before. A little bit about our team. We are staffed by professionals who devoted most of their career to this sector. We have regular dealings with various literary agents, specialist solicitors and trademark agents, and have a long history of advising authors. We're experienced in HMR revenue and customs negotiations at the highest level, and hopefully have an enviable record of success in representing our clients. We also offer a free one-hour consultation to all Society of Author members on a no-obligation basis to discuss your tax and financial affairs. So if you would like to take advantage of this offer, please email us directly, perhaps at the end. I'm going to hand over to Barry now, who's going to take you through a couple of quick points.
So, Chris, are you going to take the first slide?
Sorry.
Yeah, that's fine. I'll take the first slide. So, in the UK, we have a progressive tax system. The tax year runs from the 5th of April to the 6th of April each year. Everyone has a tax-free personal allowance of 12,500. However, this gets clawed back when your income breaches £100,000. The way it works, for every £2 over the £100,000 threshold, you lose £1 of your personal allowance, creating an effective rate of tax of 60%. Tax is usually calculated on a gradual rate, so it increases from 0% on your £12,500 of tax-free allowance, then goes to 20% on income up to 50,000, including the 12,500. The next 100,000 up to 150 is taxed at 40%, and then everything beyond that is taxed at 45%. Of course, taking into account the 60% effective rate on income between 100 and 125,000 pounds. If you receive income that's been taxed at source, you will receive a credit on your tax return. This will reduce your total tax liability by any amount of tax that you've already paid. You should also be aware that there is an allowance for dividends and also savings. These are tax-free amounts. If you're a basic rate taxpayer, you can earn up to £1,000 of savings interest without any tax. Once you're a higher rate taxpayer, this falls to £500. And if you earn any dividends, you have an allowance of £2,000 tax-free each tax year. And that's the very basics there. Barry, if you want to.
Yes, the next section relates to setting up in business, starting out. necessary to register for income tax and also for national insurance. National insurance is a separate thing from income tax, but it is collected under self-assessment. So anyone starting out needs to go online, register separately for both activities. Where a lot of authors these days, apart from being self-employed as professional authors, are also employees, it's quite difficult for many authors to make enough from writing. So there will be employed and self-employed in parallel. So it's necessary, even though you're already paying Class 1 national insurance as an employee, to register to pay Class 2 national insurance and Class 4, which is a levy on profits. Income tax starts at 12,500, as Chris said, but liability to Class 2 national insurance starts at a much lower figure, 6,475 this year, and Class 4 begins at 9,500, where there's a levy of 9% up to that 50,000 figure. So people earning towards 50,000 will have a rate of 20% plus 9% national insurance to pay. Students or people, former students, will need to deal with student loan repayments on their tax returns. Self-employed people have to pay their tax generally in 2 chunks, in January and July each year. And when you first start, your first liability will be on the 31st of January following your first year. And at the same time, it sometimes comes as a shock that you have to make a payment on account for the then current year on the 31st of January. So it's a very good idea to put money aside in anticipation of those liabilities, because by that time you're on the treadmill of making payments on account each year in January and July. Spreadsheet's quite a good idea for income and outgoings, keeps everything in one place. But we're all going digital eventually. It hasn't happened so far, but the types of software that are being introduced to cover digital filing all link up with specific bank accounts. So we are generally advising authors, apart from having the spreadsheet or other record, to have a separate business account into which most authorship items go. So all authorship income and most authorship expenses go in there, so that those are the ones which are linked with the software, and the software will lift those out of the bank account and into the record. Much better than having all your personal transactions also combined together with your tax information. Yeah.
So you've set up for self-assessment. What sort of things do you want to include as your income? So as an author, typically you'd have royalties and advances. You might be receiving some money from public lending rights. You'll also have to account for any reimbursed expenses, although on your expenses side, you'd expect to see the expenses included there as well. If you've been commissioned for a speaking engagement, you'll have to include those. Sales of manuscripts, notebooks and working papers are also included. Grants, awards and prizes are also taxable, provided that they're solicited. So if you have been awarded a prize and neither yourself or your publisher or your agent have put you forward, that prize will actually be tax-free. Some grants are also tax-free, where they're allowing you to further your writing career and not for any services or pieces of work. Another lucrative stream of income is if you sell your creative ideas for film rights. Merchandising can also be another useful stream of income. However, you probably need to be rather large to be able to get into the merchandising stream. And also if you write any articles or columns for any newspapers or magazines, that's another stream of income. We'd always recommend that you try and charge a fee. And I think, a lot of people try and ask authors to do work for free. And I believe the Society of Authors are against this, and that you should also always ask for a fee to be paid.
Just a little bit about VAT. This is the only area where digital filing is required. Where you are compulsorily registered for VAT, which means when your income from UK sources exceeds £85,000 a year, or in any 12 consecutive months, you must register and you must file digitally. So there's a separate process for registering with HMRC, and you have to use digital software in order to be able to do all that. It's important to remember that also for income tax and VAT purposes, turnover includes reimbursed expenses. So for VAT purposes, turnover is VATable. VAT returns are always dealt with quarterly, whether you're on the digital system or not. There are just different types of software used if you're not filing digitally. The flat rate scheme for authors is a bit of an anachronism now because it's really not beneficial for very many authors. We don't tend to recommend it. A lot of people do register voluntarily. You don't have to wait until you've reached 85,000. And for many people, it's beneficial to register, collect VAT and pay over, but to be able to claim back the VAT paid on expenses like agents' commission and office costs, etc. It's important to remember that last item there is that you're a self-employed person and any self-employed income is subject to VAT. So you have to charge VAT on everything, whether it's from authorship or other things. Okay, that's the end of that section.
So as Barry mentioned, you now have to file electronically and keep records electronically if you're VAT registered, if you're above the £85,000 threshold. If you're below the £85,000 threshold, you are exempted probably until next year, where we believe they're going to try and introduce everyone file electronically under NTD. The intention is that you would be keeping records on an electronic system, typically something like QuickBooks, Xero. You can file using bridging software at the moment via a spreadsheet, but again, we don't know how HMRC are going to develop this, and that system might become obsolete. So it's just something to be aware of and something to probably keep in mind. Registering for MTD means that you file everything through the software. So it's not so straightforward as just logging onto the online portal and just typing in the numbers. You have to make sure that all your records are digitally kept. This is really useful if you're under inquiry, because ultimately you can just send a copy of the digital records directly to HMRC. I find that clients who are keeping digital records, inquiries tend to close far quicker than clients with messy records.
Just to add one thing on that, it's we're saying on that slide, let's go back to that one, that the MTD is definitely coming in for everybody. HMRC have said that it will apply to anyone with a turnover of £10,000 or more. They may soften on that, but one thing that isn't going to happen is it's not going to be ready by April 2021. It's more likely to be 22 or even later if they don't have the manpower to cope with it, I don't think. And so we'll just have to watch this space. So there, the general principles are that all expenses that are incurred wholly and exclusively in the course of the profession can be claimed. The main exceptions to that are entertaining and most types of clothing. I think our tax guide will be available later, which gives a long list of allowable expenses. But we tend to draw attention to these three where care is needed. Use of home costs. HMRC are fairly generous in their attitude to this. They even give examples of how people might claim depending on the type of property they have. It can be done on the basis of the number of rooms or square footage. Consideration can be taken to number of hours spent and so on. So, but as long as you have a rationale for your argument, you should be able to make a claim reasonably substantial claim for home costs year by year. And the claim includes things like mortgage interest, rent, council tax, buildings insurance, contents insurance, lighting and heating, repairs and decorating, ground rent, etc., service charges, depending on the type of property. Keep a full record of everything, including those costs, to be able to justify that sort of claim. Travelling and subsistence. Travelling, novelists particularly have large claims very often for location research. Good idea to keep full records of that. HMRC do understand that it may be necessary to go back to the same location more than once for confirming factual information. Trips with the family have to be adjusted to remove costs other than your own generally. If you go on a trip where you're going for book research, but at the end of the trip you have a few days holiday, you need to exclude a proportion of the accommodation costs, but you can still claim your travel costs there and back. Subsistence is reasonable subsistence, it should be called, is the additional cost of your food while away from home, working, while traveling or staying away. And it's the cost of the food to enable you to perform your work better. That's the general principle. Motor expenses, you need to exclude private use in the case of motor expenses, and also telephone. With car expenses, there are two methods of claiming: either a mileage allowance, 45 pence per mile for the first 10,000 miles, 25 pence thereafter, or a proportion of the running costs, petrol, road tax, insurance, repairs, etc. With the mileage allowance, you just need to record business mileage. With the other method, you need to record business and total mileage in order to be able to get to the right percentage. You choose, when you buy the car or you first take delivery of your car, you decide which method you're going to use, and you then stick with that until you change the car. Those are the general principles involved there. So let's end our first section of the session.
We have got some other slides prepared, but we thought at this time, if anyone would like to ask any questions, that the chat function, which I think a lot of you have found already, would be a good place to answer your questions. So there has already been a couple of questions. If I read these out, perhaps then either Chris or Barry can come back to and answer them. This is a question from Claire King. In the case of royalties, with these normally being a contracted percentage of sales, does VAT have to be calculated backwards from the amount once you pass £85,000 in any year?
So only forwards.
Only forwards. I think the
second question from Claire. With income that fluctuates wildly, e.g. one big advance every 3 years, can authors spread this income out across several years rather than paying lots of tax in a boom year? In fact, it may be worth Barry going on to the slide about averaging, because I think you covered lots of points on there.
Yes, there used to be a thing called spreadback, and we at the Society of Authors campaigned to try and retain it when they brought self-assessment in, but unfortunately HMRC wouldn't buy that. So they replaced it with a thing called averaging, excuse me, which means that profits of adjoining years can be averaged with one another in order to reduce the overall level of tax. Once you've averaged 2 years together, you can average the second of those years with the following year. And in all cases, in order to be able to average, there has to be enough fluctuation of profits between the 2 years. So profit of 1 year has to be 75% or less than the profit of the adjoining year for averaging to be possible. You need to look at the national insurance implications, because by averaging income upwards, you can create or increase a national insurance liability at the same time as reducing a tax liability. And of course, you would only average if it was beneficial. The averaging doesn't require amending tax returns for earlier years. It's just an adjustment that takes place on the second of the 2 years tax returns.
Thank you, Barry. I think Claire has also asked a question about changing a contract. I presume, Claire, you're talking about the VAT point you raised earlier when Barry said about going forward.
I think if I clarify on the
contract position.
I think if I clarify on the VAT side of things, basically you would keep your existing contracts. All that happens is you would notify your publisher that you're VAT registered, and then they would charge VAT, normally there's a self-billing system with most publishers. They'll just pay you the additional amount of VAT out. So let's say you're contracted to receive, say, £50,000. Your publisher would then pay you another £10,000 on top. You would then pay that additional 10,000, say, to HMRC, less any VAT that you'd reclaim on expenses. Typically, if you had an agent as well, let's say you were due to receive 50,000, you would pay. Your agent might take, say, 10%, leaving you with, say, 45,000 before VAT. You'd still collect the 10,000 in VAT from your publisher. However, your agent would charge you £1,000 of VAT on the £5,000 of commission, leaving you with 9,000 to pay over to HMRC. Hopefully that makes a bit more sense.
There was an earlier question about small income. Do I have to inform HMRC I signed a contract with a publisher, July 2017, no advance, and publication in November 18, even though each year since I've made a small loss and the amounts of monies concerned are very small. Since April 19, I no longer have to complete a self-assessment tax return. I prepared an answer to that earlier. For the tax year 2017-18 and subsequent years, if your income from self-employment is £1,000 or under, you do not need to declare it. If it is more than 1,000, it must be declared, but you can claim any relevant expenses against it, or £1,000, whichever is the higher figure. The £1,000 claim, known as the trading allowance, cannot, however, be used to create a loss. Shall we go along to the supplementary slides? If there aren't any other questions at the moment.
So, yeah, should we? Where do you want to go, Barry? Would you like record keeping?
Record keeping is a good one. It's a very important topic. It's probably the most important tip we can give today, because HMRC do carry out inquiries into tax returns, and with the single aim of collecting more tax. So they'll be inclined to argue about expenses and double check that all income has been declared. So it's very important to have good records of everything. So we recommend keeping all bills, all receipts, all evidence possible, all statements, bank statements or credit card statements. They can be filed digitally. That doesn't matter as long as you have them and keep them. And diary notes useful because that's provides often sort of independent confirmation of what was happening in support of expenses that are claimed. And if they do find that there has been a tax under collected, and if they find that the expenses overclaimed or the income understated is £1,000 or more, they will then go back to the previous 5 years and collect tax for those years as well. So for that reason, we recommend keeping records for basically 6 years, technically 5 years and 10 months following the end of each tax year, so that you can challenge any attempt by the inspector to charge you tax every year. Part of record keeping, obviously, keeping mileage records, business versus personal calls. With telephone calls, they don't expect you to record every single call, but just to measure every now and again typical business usage as a percentage of the total. Household bills are no different from any other bills, really. It's the more records you have, the better. And the better the record keeping, the more effort you've made to comply. And as long as you've used reasonable care in keeping your records and doing your tax returns, they will not be able to charge you penalties, even though they may be able to collect additional tax and interest from you in an inquiry. So, can I do the next one, Chris?
Well, Barry, I was just going to follow up on a query from Isabel Thomas, who's asked if you averaged in the 1920 year with the 2021 year due to a big difference in income due to the pandemic, would you need to keep averaging in future years, or can you do this as a one-off? You can average as a one-off, that's absolutely fine, as long as there's sufficient difference between 2021 and 1920. The claim would be made in the 2021 year, and the adjustment would adjust for any additional or reduction in tax in the previous tax year. If you need any help with that, we're more than happy to give you a bit of a consultation on that and give you some further guidance when the time comes. It can be quite complicated, especially if you're filing on the HMRC portal. You'd have to work the tax out yourself.
On that example, you'd be reclaiming tax paid in the 2019-20 year when submitting the 2021 tax return. Another thing averaging can do is to reduce where you've got rising profits. Unlike that example, if you claim averaging to reduce the profits of the second of the 2 years, it also reduces the payments on account for the following year.
There's another question that's come through as well from Catherine Macbeth. If an author who gets royalties annually were to die, what would be the best way to prepare for the future management of that money for the beneficiaries? So Barry, I think with this one,
you probably start off by contacting the literary agent to establish a position with the titles, and see what advice the agent might have as to future exploitation, whether, for example, ebooks had been produced on any of the titles in the past. Sometimes literary executors are appointed to supervise that sort of thing. The executors could take advice in either of those ways.
And I think the key thing is as well to always consult the will first. In many cases, copyrights can be gifted to charities as well. So there's, something that should be looked at.
Another thing there is that if the author is a professional author carrying on the profession and to a date within 2 years of death, the assets, including the copyrights, constitute business property for inheritance tax purposes, and currently there is no tax liability on those.
So if the will is structured in such a way that a gift has been given, you'd want to make sure that it's not the business assets that are given away. Ideally, the author should actually seek tax advice before on how to structure their will and ensure that there's a seamless transition upon their death. And we would always recommend that all clients, authors or otherwise, have a valid will in place and have considered these sorts of things beforehand. So there aren't any more questions at the moment. So if I, hang on, there are a couple of questions. Okay, so if you self-publish, how are upfront costs dealt with in tax returns? So if you're self-publishing, we'd recommend that you register for self-assessment and record your losses each year. That will help with averaging. You can carry losses forward to offset against your trade in future, or you could actually offset your losses sideways, and that will enable you to claim refunds each year as you go along. circumstances vary from individual to individual, and it's always a good idea to check what the best option is for you if you do decide to offset a loss sideways or backwards. Catherine's just asked Barry if the author who's passed away doesn't have an agent.
Society of Authors would probably be able to give some advice there.
And then Danielle Boudoise has a question. May I ask a question related specifically related to the COVID-19 situation and furlough? And that's it.
What was the question?
She's asking if she can ask a question. So Danielle, if you can ask us a question about furlough.
We'll try.
Here we go. Okay, it's just come through. I'm an educational writer trading as a limited company, of which I'm the only employee. I have not asked for furlough as my company was paid a commission in April, May, and I was told I couldn't work and be furloughed. However, the publishing work has now stopped and my royalties on print material will be seriously decreased through lack of orders at this time of year due to the move away from print and online. I also tutor and have lost a lot of the tutees, but I still have some, so still earn a bit through my teaching online. Given the above, do I qualify for any help from the government scheme? So with regards to furlough, you could only furlough yourself if you weren't going to carry on any work. As you've carried on work and you didn't claim in the first tranche of furlough, unfortunately, in your case, you won't be able to claim now. You still wouldn't be able to claim now as you're carrying on working. I imagine you've probably set yourself a low salary and high dividends. And again, the help there would be quite low. The government has actually been under, well, I wouldn't say pressure, but there's been a bit of an uproar here because of a large number of owner-managed businesses or sole director limited companies have fallen in this gap that you're in, and there's very little help for under the limited company structure for a vast majority of directors. You could potentially get some help claiming universal credits, and there are probably a few other schemes that you could potentially claim for, but generally there's not very much for people in your circumstances.
The Treasury Select Committee came out with a report recently on this, highlighting these particular cases of company directors.
Caroline has asked a question about if you don't have to claim VAT, do you have to mention this when asked for your fee ahead of providing a workshop or talk? Do you just say the fee does not include VAT, or is some other language appropriate?
I would say just say I am not VAT registered.
Did you cover the point about losses that came in earlier? Sorry, I missed that point.
It's not a small income case.
Correct,
the first
yes.
question came in. Yes, I've done that one. Yes.
You've got that one. Good. Okay.
So again, if we just quickly carry on, if your expenses are more than your income, you don't owe any tax. Your loss needs to be commercial. So if all your business expenses, if you add them all up and they're more than your income for the year, as I mentioned briefly, you can carry them back to the previous tax year and offset that sideways. You can carry them back against the same type of income. You can also offset sideways in the current year. Sideways just means if you have an employment or earning, say, rental income or another source of income that you're paying tax on, you can take the loss from your sole trade and offset that sideways. That generally reduces your tax liability or can even create a refund depending on your individual circumstances. If you've just started out as an author and you were in employment, say, 2 or 3 years ago, then you would take the loss from the current year and you can go back up to 3 years for as a concession for opening as a new sole trader. And if you make losses in the early years, there's a similar concession if you're making loss at cessation But again, authors typically don't cease trading.
A great question has come in from Maisie Chan. When would you recommend an author get an accountant?
As soon as possible.
I think it's always worthwhile having the conversation. You know, everyone's circumstances are so unique, it's very difficult to just say that no one needs an accountant or everyone needs an accountant. It's very important that you actually go and speak to someone. I mean, that's part of the reason why we offer the 1 hour free consultation. In some cases, we say, you know, you're quite able to complete this yourself, and it's no problem. But in the vast number of cases, there are complications, and we can genuinely help clients save money by not overpaying their tax. Just simple things that they haven't considered or aren't aware that they can claim. I had one particular case a couple of weeks ago where the author wasn't aware that they could claim use of home, and I think the claim came in at something like £3,000 to £4,000 of expense per year. So it's a significant reduction in tax just from that. So.
Thank you, Chris. Shall we carry on with one more slide, perhaps?
Foreign taxes. So the UK has a number of foreign tax, double tax treaties with foreign jurisdictions. The whole point of these is so that you don't pay tax twice in another country. So let's just pick a country from the EU, for example, let's say Italy. I believe that the default rate of withholding tax in Italy is 28%. So if you just sent off a piece of work and you received payment from Italy, they'd be obliged to withhold 28% of tax without completing a form from the double tax form that you would have stamped by the UK tax authorities, then sent to the Italian tax authorities or the Italian payer. In fact, they would deduct 28%. With completing the foreign tax form, you'd only pay tax, or you'd only have tax deducted at 8% in Italy. Now, if you're a UK taxpayer and you've paid 20% tax, the tax on the Italian chunk of income will have a credit of 8%. So you'd only have to pay an additional 12% on top relating to the UK income. So it's a very useful way of bringing down your overseas tax liability. Otherwise, if it was 28%, you'd get a credit up to the 20%, but you won't get the 8% back. So it's always very important that you complete certificates of residence or double tax foreign withholding tax forms as soon as you know you're going to receive any income from a foreign territory. Let's just see if we've got anything else there. HMRC can deny you tax credits if you haven't completed these forms as well. You have an obligation to mitigate your tax liability in a foreign jurisdiction. So it's always a good idea to make sure that your paperwork's in place beforehand.
Thank you, Chris. Claire King has asked, do you need to declare yourself as a sole trader, or is that implicit in registering for self-assessment? As a sole trader, do you need to produce annual accounts beyond the self-assessment?
No, they are one and the same thing. You can produce accounts if you want to, but a sole trader is any individual trading alone and will always submit self-assessment tax returns as long as their income's over £1,000.
I think we've probably got time for a couple of last questions, if anyone wants.
I think there's one from Ruth Downey. How does making a payment into a pension scheme affect tax? So if you're talking about Nest, which is usually deducted through your employer, if you're not part of a salary sacrifice scheme and you're a higher rate taxpayer, you can make a claim against the employee element of the contribution on your personal tax return and obtain tax relief. If you're a self-employed author and you're a higher rate taxpayer, it's really useful to make pension contributions into a SIP or a pension fund. Normally what would happen, let's say you were to make a contribution of £800, the government would top this up to £1,000, giving you another £200 in your pension pot. And as a higher rate taxpayer, this would reduce your tax liability by a further £200, because the place where higher rate tax kicks in is shifted by the gross amount of your pension contribution. So it's a really useful thing to do. In particular, if you're at the £100,000 mark, if you're between 100 and 125,000 pounds worth of income, that's a really, really good place to make pension contributions. And I'd highly recommend that you speak to a financial advisor and an accountant, and they can advise you on some serious tax savings there.
Catherine Macbeth, thanks, Chris, has asked a question about benefits becoming a limited company. And we've just about got that's the next slide, I think, isn't it?
We can. Let's do the.
Let's have a quick one.
So it very much depends on personal circumstances. This companies go in and out of fashion rather. They're less beneficial since George Osborne introduced a dividend tax, which tended to reduce the benefits. The main benefits arise to people receiving enormous amounts of money, which can be sheltered within a company, and money can be drawn out over a number of years, and taking advantage of the lower rates of tax paid within companies, 19% corporation tax versus the various rates of tax that individuals pay, up to 45% plus 2% national insurance. Other people who can benefit are people with partners. Couples can have shares and share the income that goes into the company between them in form of dividends, thus taking advantage of personal allowances and lower rates of tax. But there are disadvantages. If you have a good book deal, the money goes into the company and you decide you want to buy a flat, taking the money out of the company, you get hit with quite high dividend tax, up to 38.1% on money withdrawn. So you have to be careful to do it at the right time and things in the right order. There is more administration and there are higher costs. So as it says there on the slide, specific advice should be sought. Every case is different. And it's important as well to remember, be very careful about assigning copyrights into limited companies, because there are considerable tax penalties for that.
I think it's important to also add that you should always speak to an accountant before deciding to go limited, because there are so many issues. Barry's actually written a fantastic article on our website that I can share with you now on the group chat. So please feel free to visit that link.
Thanks, Chris. Caroline has asked, are grants from the emergency fund for authors taxable?
No, they're emergency awards in relation to financial hardship, so not taxable. Alleviation of financial hardship.
I think one final question from Marie Luxton. If I have an accountant, will I have to keep digital rather than paper records soon? I think we covered that earlier.
Yeah, you will. You will. Everyone has to keep digital records. It's your responsibility, unfortunately, not the accountants. The accountants can help you. We do it for a large number of our clients, but ultimately the records do belong to you, and they are your records. I would always advise that clients understand the software and understand what's going on, just because accountants can make mistakes as well. We have seen it where we've taken on other clients where the records haven't been 100%. It's something that you need to try and understand and get to grips with.
Francesca, are you happy for us to continue, or should we call it a day there?
I think we've just about run out of time, but if there's any last few closing remarks you guys want to make, or one final slide that you want to quickly run through, I think we can maybe squeeze that in.
think we've covered all the questions. Just tax inquiries, yeah.
So I think this is a typical point. I think there were over 300,000 tax inquiries last year for the 18-19 tax year. COVID didn't really slow it down. They can be random or selected. Selected ones can be triggered by anything, something as simple as putting the wrong figure on in the wrong box on your tax return. HMRC normally have access to vast amounts of information. There's so much information out there. They can use things like Facebook, open banking. They can really get a vast amount of information before they even come to you if they think something's untoward or incorrect. There's penalties, there's interest that will be due on any underpaid tax. The inspector's aim is to try and discredit your records. So that's why it's so important to keep the records in order, and why we've spoken about it so much in this talk. If you're with an accountant, most accountants offer something called professional fee insurance. That's really useful. Professional fees can really mount up. We've had large number of inquiries. Some of them we can close with a single letter in cases where everything's been kept in good order. In messy cases, it can run for a good couple of years. I had one of my colleagues, I think he had an inquiry running over 3 years, and he just had a really difficult inspector. Not that there was anything too bad or wrong with the client's records. It does just happen. I think if we go to the next page, I think there's we do have a quick rundown on penalties. The more you take care, the lower your penalty should be. If you've just made a genuine error or mistake, there's not usually a penalty. The key thing is, if you discover an error, you should inform HMRC. They're far more lenient if you go to them than if they come to you. And I think you can see from the table there the sort of levels we're talking about. Maximum penalty can be 100% of the tax. If there's offshore aspects, it can be as high as 200%. So please just be careful and make sure that with everything that you're doing, you keep your records in good order.
Thanks, Chris and Barry. And from my point of view, I'd just like to say thank you to all of you for listening. We will send a copy of the notes, Francesca, if you'd like to send them round. And we also have a handy authors and journalists tax guide, which again, most attendees already may have, but if not, we'll happily send the link for you to forward on. But thank you, Francesca, and everyone for today. Much appreciated.
Sandra's asked for a copy of the slides. Will we be sharing the slides?
Yep, if you guys are happy to, I'll send around to attendees along with the tax guide that Andrew just mentioned. They'll be sent round just shortly after, probably tomorrow. Thank you so much, Andrew, Barry and Chris, for taking the time to give us this presentation and answer all attendees' questions. Thank you so much. I'll just run through a couple of things that are coming up. Tomorrow we have a session with some of this year's SOA award winners at 3 o'clock, and Thursday's afternoon tea is with Barney Norris at 4 o'clock. So you can head to societyofauthors.org/events to book. There's still places available, and the link will be in the chat as well. Thanks again for joining us. And if you do want to continue the conversation on Twitter, the festival hashtag is #SOA@home. Thanks so much.
Thank you.
Thank you, everybody.
You, bye all.